Sorry. All right. Welcome to week 7. So I took a small peek at the midterm. I think most of you did okay. Some of you had some trouble with just for example, just fundamental definitions of what carry trade is, for example. Um, so I will just try to make sure everyone's caught up to speed at the midterm level. So I'll go over the solutions next week. The TAs are still in the process of grading. They've told me they graded your class and Thursday's class and still haven't done Wednesday's class. So I told them just to wrap things up by the weekend. And so you guys have to wait 1 week. Yep. So does anybody have general questions about the midterm? Some people finished early, so that's good. That's usually a good indication that there are those who understand what's going on, and it should have been an easy test, I think. Others, I suspect, you kind of get the gist, but you kind of didn't spend a lot of time, going over the material. So you just took the time during class and went over the material, which is fine. And I think that's where most of you are at. And you guys just basically followed the lecture, but didn't go really in deep until you were forced to in class. So I don't want to speculate what the average is, but I think most people did okay. That's my hunch. All right. So if there's anything that was super confusing on the exam, I can address it now. Otherwise, we can just wait until next week where I go over the solutions in class. All right. So this week agenda is building off the model that we talked about 3 weeks ago. So the week before the midterm and the long-term discussion with relative PPP, like purchasing power parity. So what we are going to do is kind of build off the short-term model. So the short-term meaning this kind of model, right? We call the short-term models where we have exchange rates on one axis, interest rates, and money demand, right? This is the short-term model. We don't think about inflation and targeting, anything like that. It's just a static model. And we're going to try to now think about how to model this specific parameter, right? So we know where R comes from, right? Comes from demand, money demand equaling the money supply, right? We know where interest rates comes from the central bank. We know how exchange rates are determined because we understand that if the market is efficient and if investors are on average close to risk neutral, then we should have UIP being true, which means that carry traders on average make nothing, right? That's what it means. And if that's true, then their carry trade will tell us the direction in which exchange rates should move, right? Depending on which carry trade they're doing. They're borrowing domestic or borrowing foreign and lending, et cetera, right? That tells us how E should move. However, there's one component that we didn't really discuss yet is how is output, right? How is output determined in this model? And we kind of just assume that it depends on, it's by choice. I just told you there's a external shock to the economy and that economy suffers, and as a result, demand for money suffers. That's kind of what I did so far. But today we're going to be a little bit more explicit. We're going to again go into more macro modeling. I know that's very abstract, and I guess some of you are not familiar with such abstraction, but I assure you that it's very helpful to understand policy policymakers' actions. So just recently, for example, today, what do tariffs actually look like from the fiscal policy perspective, right? How does that, we know that tariffs have a price impact. We also know that it has potentially a income effect, but that income effect, however, is ambiguous, right? Because you can get more income from tax revenue collected from tariffs, but you can also suffer because your production, for example, your output of the economy is suffering because it's harder to compete on the global stage, right? Because you have tariffs. So we're going to be explicit, in other words, right? So we're going to be explicit how Y is determined, and we're going to make this Y basically depend on everything, right? So Yeah, so that's the goal. The goal is to link this model or this market. So you can think of this market as purely financial markets, right? Because we're talking about exchange rates, that's a financial instrument. Here we're talking about money and deposit rates, interest rates. This is all financial. But ultimately, we want to link everything to the real economy, real output, and that's where we have to spend some time modeling why. Okay, and so this is all consistent with the framework that you've learned up to now. All right. So in order to begin our understanding of how to approach modeling why, we need to spend some time how to interpret Q now from the real perspective. So Q so far, I just told you, it's a unitless measure, right? It's supposed to be a ratio of price levels, right, between countries. And it's supposed to be, as of your understanding now, a variable that represents whether or not you should buy foreign goods or services or buy domestic, right? Because if foreign goods or services are more expensive, the ratio changes, and that will drive incentives such that you will avoid foreign goods, right, in favor of domestic goods. In fact, other countries may also favor your goods over their own goods. So exports rise, right? That's what you're understanding so far. But today I'm going to give you an actual unit for Q. All right, it's a unit because I'm going to put a unit associated to price. All right, so price, you can think of just an average level, right, from previous weeks, but now we're going to think of price as a per unit of something. So that's where we get this interpretation of Q as an exchange rate, but for real consumption. So that's what I'm going to do first. All right, explain to you how Q is interpreted from the real sense rather than the financial sense, and then realize that Q is our nexus that links the financial markets with the real economy. Why? Because real goods and services move due to the current account being a function of Q, right? So this is our intersection, right, between the real side of the economy versus the financial side, right? Financial side meaning price levels and everything is here, exchange rates here. And the current account is what drives international trade, and international trade is flows of goods and services, and therefore linked to output and so forth, right? So that's where we're heading. Okay. So I'll talk about the rest of this stuff, but to look ahead, the way we model the macroeconomy, we're going to use a very, very basic model from Keynesian economics, where we presume that demand creates its own supply, meaning that if the economy, if people want it, okay, if people want something, then the economy eventually will produce those goods and services to meet those demand, right? That's the gist of the idea. So you may have heard the other opposing argument, maybe supply creates the demand, but for our purposes, we're going to keep things simple, and we're just going to assume that in an economy, demand is going to create supply, right? It's just a mechanism that we have that allows us to forecast how output moves in response to all the other variables that we've seen before. Okay, so let us talk about the real economy. And we're going to talk about this through Q. So we all know the current account equation, right? It's a function of Q, but we're going to be a little bit more explicit about what parameters or additional parameters could also move Q in addition to Q. So Q here is a function of the real exchange rate. So we all know that, right? This is the incentive to import or export because of price ratios. But of course, it can also be a function of income, but not only domestic income, but also foreign income. I didn't write it here, but as you can imagine that foreign income can also play a role, as if your trading partners become wealthier, right, then they are more likely, have a higher likelihood, more propensity to import goods from you, right? So it could boost your exports. And you can see that if we decide to write exports and imports as a function of not only Q, but also disposable income. Right, so remember Y minus T, what it represents. It represents total income generated by production within the economy minus tax liability, right? And the star represents whether or not we're talking about a foreign country or domestic country. So exports, obviously a function of price levels between countries, right? That's the driver of import, export volume. And then we have also foreign disposable income. So that's, I think, clear now. If people from abroad get wealthier, they're more likely to buy stuff from you. That's going to boost exports, your domestic exports. So positive here and positive here. Imports can be written as a function of also Q, right? Because if goods and services become more expensive, you will curtail imports. So Q obviously also an important parameter. So I think that's a minus, right? Higher the Q and then the lower the imports. But for domestic income, it should be positive, right? And I think we mentioned that last or a few weeks ago, right, in our lecture. So all these relationships, I think, very intuitive, right? But of course, what's not so clear, however, is how to interpret Q itself, as opposed to, right? Is it just really just a representation of incentives to import and export based on price levels, or does it represent something more than that? And I'm here to tell you it does represent something more than just a price ratio. Okay, so how do you see this? You can see this by thinking about what we should associate P and P star with. Like when you pay P star or P, what are you paying for? So the macroeconomic argument is that you're actually paying for a unit of output. So it's kind of like price times quantity, right? So if I pay P star, I get a output unit, or you can think of it as a consumption basket, right? One basket of consumption, right? So if that's true, then of course you can think of price P star and P as a cost, right? It's the cost of something in order to get something. Just like the stock price is something you have to pay, right, to get access to that unit of stock. We can think of P star and P also getting access to a unit of consumption output of a country. So here, P star, foreign output unit, I think it's clear, right? We're thinking about consumption baskets, a unit of P times Q, right, from a country. But it's important to know that this consumption basket is not the same across everywhere, right? It's a foreign output unit, right? It's a foreign output as opposed to a general output unit. Same for P. P is a domestic output unit, right? And once we assign units to P star and P, all we have to do is rearrange all these variables. You can just factor out EP star over P, right? That's kind of just a numerator, right? And the ratio that we get is the following, you see? So now it has a real interpretation, right? Not just a financial one, not just the price incentive, right? To buy import stuff or export stuff. It's a price actually of foreign output, but in terms of domestic output. So what's the exchange rate between baskets of goods, right? If I take one output unit from Hong Kong, how much of it do I need to buy one basket unit of output from China, right? This is what it's saying. It's not a price ratio anymore. It's an exchange rate, in fact, right? It's an exchange rate between baskets of goods between countries, or output units between countries, right? And so now with this interpretation, it should be very easy to understand why we can write imports in this fashion, right? Equals Q times EX star, because Q is the price of foreign output in terms of domestic output, right? That's what Q is. And EX star, because there's a star here, it's a measure of imports measured in foreign output units, right? That's what this means, right? This quantity there, let me say that again, because it's EX star, it's domestic imports, but it's measured in foreign outputs, right? That's what this is, right? Imports, but not measured in domestic units, but foreign units. So that's EX star. And then once you see that the units are domestic over foreign, and then import measured in terms of foreign, let's see, the foreign output cancels out, right? And all you get at the end is domestic units, right? So they must be the same, right? IM must be equal to Q times EX star because the units are the same. So now you know, now it's a very clear, right? It's a very clear picture showing that imports can definitely be written in such a way which we're multiplying Q by EX star, right? They are the same because they are the same units. Okay. So now with this in mind, right? We can now start thinking about the macro side, all right? And of course, we'll talk about the conditions in which the relationship of CA with respect to Q is still positive. Like, what's the necessary condition in which this is true, right? We will talk about this sometime later in the slides, but that's what you should be thinking about, right? We already kind of assumed this so far, but of course, given this expansion of or augmentation of the current account definition, we can now be more explicit what those conditions has to be. Okay. So I'll talk about this later. All right, so let's get to the slides then. All right, so our topic of discussion today is flexible exchange rates and output in the short term. So I mentioned earlier, right, short-term model, meaning that we're still working with this kind of framework, right? We have E, R versus L. So we're not assuming there's inflation. We don't care about that in this framework, but we still allow prices to respond to other variables in the so-called long run, but inflation is just assumed to be in the background or it's negligible. Flexible exchange rates, I hope this is not confusing because this is something that I wasn't emphasizing too much, but it means that we're not talking about governments or central banks that directly intervenes in the foreign exchange rate markets, right? So countries like Hong Kong, Singapore, China, they're kind of on the boundary of being flexible or fixed, right? They're kind of quasi. So we're not talking about these specific countries. We're more talking about the US, where there's no explicit policy where they intervene and have a portfolio of currencies so that they manage exchange rates across, different countries in which they have international trade with. So we're going to start with that, in which we have floating/flexible exchange rates, in which governments don't actively intervene in the foreign exchange rate markets. And then over the next 2 weeks, we will talk about exceptions, in which we have crawling pegs, crawling bands, crawling pegs, or a traditional fixed exchange rates, or currency boards, which is what Hong Kong has, right? The analysis, of course, we just assume that they're more or less pegged exchange rates, and we do subsequent analysis later. But I just want to make that distinction. We're talking about countries that don't actively intervene in the FX markets. They don't have a portfolio of currencies. They don't care what the exchange rate is. All they really care about is monetary policy, right? That's the only tool that they have at hand. Okay, so ultimate goal today, maybe if we get lucky, we can finish early. But my objective here is try to build a model on aggregate demand from the ground up. So for those of you who have macro background, this is something you've heard of before, definitely, because it's part of ISLM or whatever. But if you don't know what that is, that's fine. I will build everything from the ground up, and hopefully the way I explain it is good enough for you to do okay in this class. All right, it's not necessary to have any background in macro to understand this. All right. So let me recap a bit. So far in this class, we've up to the short-term model we talked about before we were introduced with purchasing power parity. We focused on the financial side, right, in which the current account is defined in such a manner. CA minus S minus I. We talked about investments. We talked about FDI, right? We talked about these things are relevant because it can distort the current accounts, in one way or the other. But now we're going to think about specifically the real side, okay? And then we need to talk about how the current account can change stuff that's produced in the economy, right? The current account is going to do that through, of course, through Q, right? And we kind of, whatever I showed you in the previous slides, right? Now we can augment the current account to see how trade flows is now determined, also determined by exchange rates, right? Because it's part of Q. And so that's what's important today, is to understand how exchange rates can feed back and determine what output should be, and output can also determine what E should be. And so there's this feedback, this interdependence, which makes things a little bit more complicated when explaining such a model. So that's the thing I'm going to try to hope to get across today without confusing too many people. So last 2 weeks ago, right, everything is quite linear. P changes, this must change, and that must change. MS changes, that changes R, that changes exchange rate, that changes exchange rates, right? A causes B causes C. Everything's super, super linear. And so as long as you understand those things, it should be very, very simple to understand like what we learned so far. But today it's going to get a little bit complicated, because as you can, if you realize, Y appears in many places, right? It will appear in many places. And when Y changes, E will change. When E changes, that will feed back into Y. Things get very, very messy very fast. So that's just a warning, okay? So things will get complicated, but it's necessary, okay? Because that's how we achieve equilibrium, right? All right. So what we're going to do is we're going to model aggregate demand. And aggregate demand, what you should think of it is just total income, right? So there's two ways to think of it. You can think of aggregate demand as the sum of all income, right? That's one way to think about it. Think of all the workers, they make money, and we're just adding all the money that they earned, right? That's one way to think about aggregate demand. Maybe something a little bit more similar to what demand means is maybe we're talking about all planned expenditures. Right? I think this is probably a little more intuitive to think about aggregate demand in this sense, right? So aggregate demand is supposed to be the equilibrium output for the economy, right? That's what it should be. You should only produce as much as people want, right? So that means households have income that they can spend, how much they consume. If businesses need investments to make stuff, they will get financing from households as well, or investors or whatever. That's also part of aggregate demand. And there's also government spending. So all this stuff should all sound very familiar, right? Because what I just said is basically C plus I plus G, right? But of course, there is net exports, right? Let me write CA here, right? So that's what aggregate demand is, right? So something you've seen already. So let me say that again. Aggregate demand, as it sounds, it's supposed to aggregate the amount of total output generated by an economy. How do you know how much they generate? Well, you need to include everything they consume, everything they use to invest in businesses and their expenditures to produce things. You have governments also spending, buying stuff, right? That's also should be part of output. But there's also output that you need to create to sell to other countries, right? So all this stuff, when you add it all up, is a representation of, you can think of it as income, or probably a little bit more accurate is planned expenditures, right? So once we have an idea of what we're after, we need to think about how do we achieve equilibrium, right? So the mechanism is the following, according to Keynesian's way of thinking things. If a economy is producing beyond what is demanded, right, then businesses will incur losses because a lot of the stuff they're making is not being sold. The inventories are expanding, and consequently, their costs will get out of control. And so they have every incentive to cut costs, to reduce their inventories, and to lay people off. But there is a feedback loop, as you can imagine, because as you lay people off, income in general will go down, etc., until hopefully you converge at a point in which all things created in the economy equals all things demanded, right? Supply equals demand. On the other hand, you can also think about the other side in which you have not enough stuff being made, right? So if your demand exceeds the total amount of supply, then an economy will have incentive to expand production, because if they expand their inventories, then those inventories will be quickly sold, right? So in the case of underproduction, inventories are shrinking really fast, and they can definitely make more money by hiring more people, paying more salaries, producing more output, and expanding output and income for everyone. So that's the idea. There must be an equilibrium in which we don't have any excesses and we have no shortages. And that's when our aggregate demand precisely equals some equilibrium output, right? That's the Keynesian way of thinking, that supply is always responding to how demand changes. That's the idea. And we achieve equilibrium precisely when aggregate demand is equal to some equilibrium level Y star. And my job now is to explain to you, where does this Y star come from? Okay. All right, so so let me tell you those components right now. So I will eventually parameterize every one of these variables. So let me give you just an overview of what I'm trying to do. So in the last few weeks, you remember this formula, right? But up till now, you kind of assume that C, I, and G are just independent from each other, right? They don't depend on each other. They're not there's no causal relationship between any of these variables. But now I'm going to impose structure now, all right, in which there could be potential feedback. All right. So consumption, what I mean, let me give you an example. So consumption, what drives an economy to consume? Their wealth, right? Their total income of an economy, right, can drive consumption. So I can make consumption now be a function of output as well, right? Namely disposable income, right? But you can see that output here, or total income, is also on the left-hand side here. So as Y increases, this can definitely feed back into consumption and continue to boost consumption. And when consumption boosts, this further boosts and so forth. So there is this feedback now in our math, all right, which will be complicated a little bit. In this class, investments, if you recall your ISLM model for macro, it's a function of interest rates as well as income. But for this class, I'm just going to assume that it's independent from everything. All right. So just for your background knowledge, interest rate or investments are a function of interest rates, because higher interest rates mean higher discount rate, right? And so that's going to kill your NPV projects, right? So imagine your investments, just an NPV project. If your discount rate is higher, then your investments are going to be worth less, right? So it's a negative relationship between, I don't know. But anyways, that's your typical, that should be what you're thinking. But for this class, to keep things manageable, I'm going to assume that investments are not going to depend on anything. It's just taken as a constant. Okay. Same for government spending. As you can imagine, government spending could also be a function of household wealth, but for this class, I'm just going to assume that it's independent, externally determined, or just a constant. And lastly, we already mentioned current account. We're going to be explicit. We're going to say it's a function of Q as well as disposable income. So you can see there is a feedback here, here, and here. And things could get pretty complicated. But just just have that in the back of your head when we work through predicting curve shifting later on. So I already said this. So why D stands for disposable income. I will just write it out explicit just to be clear. It's a function of total income minus taxes. And consumption now is also a function of disposable income. Sorry, it is a function of disposable income. And the logic, of course, is clear, I hope, right? You're wealthier, you have more money, and you're gonna smooth your utility, I mean, you're gonna smooth your consumption right over time, and so you're going to increase consumption if there's a wealth shock, for example, right? So one thing we're gonna bake into our model is that people, in response to an income shock, they're not going to spend all of it. Does that make sense? So if I gave you $100, I'm going to assume that you on average are not going to go out and spend $100. You can, some people will, right? They have perhaps very, very, very high discount rates and they just decide to spend the money. But in general, we like to think that some fraction of the economy or some fraction of households will save, right? And so it's not going to be a one-to-one relationship between aggregate demand and disposable income, right? It's not going to be one-to-one, right? You're going to imagine that people are going to save. So maybe I write this more to sleep. What I mean is that the propensity to spend or to consume in response to a small change or a unit change in disposable income is going to be between 0 and 1. Does that make sense? Or if this doesn't make sense, I can write in delta, which is fine. Suppose I changed, I'm looking at the change in consumption, given a change in a unit change in disposable income. This sensitivity, right, to change in domestic income will be between 1 and 0. What this is saying is that some households will save some money and not spend it. Makes sense? So this is an assumption, okay? In fact, it's a necessary assumption to actually get an equilibrium in such a framework, the Keynesian framework. So we need this assumption that there is some savers in the economy. And that allows us to find a stable point in which businesses will not produce more or less because otherwise you get shortages or surpluses, right? Those are costly to businesses. All right. So as I said, investments is going to be assumed to be unaffected by short-term changes in interest rates. So that means that I is taken as a constant. But just for your reference, we usually assume that investments are a function of real interest rates or real interest rates, right? Again, the discount rate argument or the opportunity cost of pursuing an investment in the first place because of higher interest rates, right? There's two different ways to think about it. And also we're assuming that G is autonomous, meaning that it's a constant or it changes because I said so, right? It's not going to be a function of R or anything else, okay? So maybe I'll write something here. Assumed to be determined outside model that I not dependent on other parameters. That's what I mean. All right, so far, so good. So maybe I recap a little bit on what I try to introduce to you. So I tried first to explain how to think about uh, total demand for goods and services produced in the economy. One way to think about total stuff produced within the economy is to think of it as income, right? Because if I make money, I'm going to use my money. I'm going to use all of it for something, right? Either to buy stuff, that's C, either to invest in businesses, and those businesses go out to buy stuff, that's also I. If the government buys stuff, that's also G, right? And then if other people outside our country buys our stuff, we also need to make stuff for them, right? Because they're paying us. But all of these things added together really is right our income because we're selling this stuff either to everyone, each other, or to somebody outside of the country, right? So income or planned expenditures, that's kind of our way of imagining a real aggregate stuff made produced by a country, right? So how much stuff to make? Well, it depends, right? We need to determine what that is, what's that Y star. And this requires the assumption that demand creates supply. This is the Keynesian idea of how an economy works. Keynesian. Yeah. So comments, questions on what we're trying to do, right? We're trying to create a model in which we can determine the equilibrium output produced by a country, right? What are the ingredients? Well, the ingredients, as you already know, C plus I plus G plus CA. That's just a measure of total income because I'm going to use my income to buy stuff or invest in stuff. That's what aggregate demand is supposed to represent. Another way to think about it is total spending, right? By everyone, right? From our country. So not only household, but everyone outside the country who wants to buy our stuff. We need to make it for them, right? That's also considered. Now we need some ingredients so that we can achieve an equilibrium output. And the ingredients is, first of all, we need to assume that demand creates supply. And I'll show you a graph to explain what I mean by that, okay? Demand creates its own supply. That's number one. The second ingredient is this one, okay? The response of consumption to tax changes is less than proportional because part of disposable income is saved. Response to consumption. Okay, yes. So tax changes would change your disposable income, right? Or just change in Y. Tax or Y, okay? Changing this by 1 unit will change consumption by less than 1 but greater than 0, which means that people save money. So you need 1, demand creates its own supply assumption, and 2, response to changes in disposable income is less than 1. These 2 ingredients will give us a way to achieve equilibrium output, as you will see very soon. All right, so before I show you the Keynesian stuff, I need to talk about the current account in greater detail. Because I need to assume that the current account responds to Q in a positive manner. And I need to convince you that I need to give you the math to show you the assumptions I need to make such that that is true, that there's a positive relationship between Q and the current account. So trade related determinants of the current account. So the current account now, rather than S minus I, is defined in this fashion, EX minus IM. And now you know how EX and IM are determined, right? You know those inputs is it's gonna be Q and Y minus T star and Y minus T, right? All those stuff. You know how to augment the model. But now I need to prove to you show you the condition that must be satisfied such that Q has a positive relationship with CA. Okay. So let me do that now. This is probably the most math you'll see in this class, I think. All right. I hope it's not too difficult to comprehend, but if you don't quite understand the math, my suggestion is just to memorize it. Okay. It's an important criteria for the analysis that in order to use this model, it's an important criteria that must be met. All right. So, given this parameterization of the current account, which is a function of the real exchange rate and disposable income, we're more concerned is this relationship here. Okay. So what conditions must be met such that this is true? And this is asking you this is telling you that the relationship between the current account and the price ratio or the price of foreign goods in terms of domestic goods, right, is increasing, then the current account will be positive. So what's the condition for that? So that requires some calculus, unfortunately. All right. So let's go ahead and just ignore the disposable income part for now, because we're just taking partial derivatives. So we can just hold the income levels constant. And taking the derivative of the current account with respect to Q in this way of writing the current account equation. So EXQ minus Q times EX star. And as you can see, EX is a function of Q. EX star is also a function of Q. And we've replaced the import now with exports, EX star, foreign exports, right? So this mapping from IM to QEX star should be very straightforward, right? Because as I explained, Q is the price, or the Q is the exchange rates of foreign goods in terms of domestic goods now, right? So replacing IM with Q times EX star, they are equivalent, right? Because all I'm doing is just using the unit change. All right, so with that, we can take the partial derivative of the current account with respect to Q, right? And because it's linear, we can do it piecewise, right? We can do it here, take the derivative with respect to Q for here, and then take the derivative with respect to Q is for here. This is easy to do, right? Because it's just one function. So derivative of EX with respect to derivative of Q. So partial EX over partial Q. Right? And that's it, right? Because partial Q over partial Q with respect to Q is just one, right? So it's just, we're done. Minus, now we need to apply what's called the product rule, which means that if we have, for example, F, G, we take the derivative, we're taking the derivative with respect to F first, and then holding G constant, and then holding F constant, taking the derivative with respect to G. I hope you've seen this before, okay? That's all I'm doing. So let me show you what I did. Here we have Q, right, times, this is our F, and then EX star, this is our G, right? So let's do this one first, right? Holding F constants, holding Q constant, and then taking derivative of EX star, the partial derivative of EX star with respect to Q. So that's this term here, right? Holding Q constant. Now the other side here, the other part of the product rule is taking the derivative with respect to F with respect to Q. So that's Q, derivative of Q with respect to Q is just one, right? So it disappears. And then we hold EX star constant. So that's this one here. Next, we group similar terms, right? So here we can see that these look very similar because they look like trade volume effect, right? Because here we have the sensitivity of exports when Q increases, right? And here we have the sensitivity of foreign exports when Q increases. So putting it together, we see that the total effect when group of this grouped terms is going to be positive. I hope you can see that, right? Because by assumption, right? Exports is positively related with Q, right? Because if goods abroad are more expensive, domestic exports are more competitive, and exports should rise. Conversely, if Q rises, that means people will be avoiding foreign exports. And so EX star, its sensitivity is going to be negative. And negative times a negative here, right, is going to be a positive. And so the entire, this entire expression here is going to be positive. So if you recall a few weeks ago, I mentioned the difference between volume effect and value effect. Well, this is it. I'm very explicit now, right? So the sensitivity of the current account with respect to a change in Q is going to depend on the magnitude of this expression, which I termed the volume effect, because these sensitivities are change in commodity flows, right? When prices change, relative prices change. Whereas this term here, EX star is going to be some positive number, right? Exports and imports are all positive numbers. And so minus a positive number will always be negative. And now we can see the value effect is undermining the current account sensitivity to Q, right? So the question is this expression on the left-hand side, or highlighted in green, going to be bigger or smaller than this right-hand side here, right? And so the condition in order for an increase in Q leading to increase in CA requires us to assume that this entire expression is greater than 0. So this thing has a name. This is called a Marshall-Lerner condition. And for over the next few weeks, we're going to assume that this condition is true. Okay, so another assumption we are making now. So far, I've given you 3 assumptions, right? Assumption 1, demand creates its own supply. Assumption 2, we have savings, right? On average, households will save if given an income shock, right? And number 3, we're going to assume now that the current account responds to Q in a positive manner overall. Even if the value effect is non-zero, right? It's positive, or is a negative number, that negative number will be overshadowed by this other expression of volume effect, right? And that's by assumption. That's the condition that we have to assume to be true. All right, so to recap, why do we care about the current account? The current account is the nexus that links the financial markets that we know well from the first 5 weeks of class, right? The financial markets. And it's going to link to aggregate demand because that's where stuff gets produced, right? You make this stuff because some other country wants to buy it for you. And so a higher current account means more stuff, more income for you. That's going to affect the real economy. So this is the nexus that links financial markets with the real economy. That's why we care. Why do we care about the sensitivity of Q with respect to CA? Well, this is the pass-through effect. We want to know how effective prices are and how they will respond, how they will impact the current account. So from a policymaker's perspective, this is very important because depends on how how strong your price impact is that will impact, that could be a strong or weak effect on your exports. And you want to be able to quantify this from a policymaker's perspective. So if you're Donald Trump, you know that price levels are going to be higher somewhere, abroad or domestically. How is that going to impact their current account, their trade? Is he ever going to achieve his manufacturing, export-driven economy? I don't know. But I imagine if he had a group of economists, this is something that he's looking, he wants an answer to, right? All right, so now you have a robust understanding of the condition that must be true for the current account so that we have a positive relationship between the real exchange rate and net exports. You know the assumptions that must be true in order to find an equilibrium output level. And now I just have to explain to you how everything fits together, right? So I did this already, right? Yes. Yeah. So Q depreciation just means increase Q, right? So I just want to be clear. Q depreciation means this. And we're going to assume that it's possible. But just, so this is going to be, sorry, assumed. The Marshall Lerner edition. And of course, ex ante, we don't actually know if this is satisfied. Must be tested somehow, right? Which is why I wrote ambiguous, right? Because the value effect could indeed dominate, perhaps in a very short time window. So this is the summary, right? I'll leave that to you to read, but again, the intuition is the following. It's called the volume effect because we're looking at trade flows, right? We're looking at change in EX and change in EX star in response to a change in Q. Whereas value effect, we're basically assuming that the value effect has nothing to do with trade flows. It's just the price level, right? You can think of it just minus EX star. This is telling you that if there's no trade flows, for example, then we're just seeing that imports getting more expensive abroad. And if you're just paying more, that's going to undermine your current account value, right? It's going to decrease, go down. Paying higher price for same amount of imports, right? That's what it's saying. All else equal. All else equal. All right, let's now summarize aggregate demand. Let me give you the equation, right? You want to see the equation for aggregate demand. This is what aggregate demand looks like. So I'm going to use D to designate aggregate demand in this class. Aggregate demand is just the components of G and P. Have you seen before? C, I, G, the current account. We've parameterized aggregate demand through domestic disposable income and the incentive to export or import, or another way of saying it, the price of goods in terms of domestic goods. And I'm going to hold I and G to be independent of all the variables. It's going to be determined outside of the model. So we don't have to write this all out every time. In fact, we can just think about the inputs of this model. Here, we can think of just a function of the disposable income and I and G, of course. They're just set by the modeler. So we're just going to just have that as generic inputs. And of course, Q is going to be in this model as well, where Q is equal to, as you all know, PP star P. Now you might be asking, wait a second, disposable income seems to appear in this model twice. It seems to be positive related to current account, the consumption here, right? Because the wealthier you are, the more you're going to consume. But here it appears to go in the opposite direction, right? If domestic income increases, I'm more likely to import, right? And if my import's increasing, then my current account should be decreasing. So there's another assumption here that we're going to make. The consumption effect will overshadow or subsume the, let's just say, overshadow, okay, the import. So mathematically, what I'm saying is that the change in consumption with respect to a change in disposable income is going to be way bigger than any sort of change you see in imports with respect to change in domestic disposable income. So when I write it in this fashion, then we can conclude that y minus t will have a positive effect on aggregate demand, right? Because the consumption dimension is much bigger, right, than the import. Investments is going to be positive. Government spending is going to be positive. And lastly, Q is going to be positive on D because of Marshall Lerner condition. And I'll be explicit here. Volume effect greater than value effect. Comments, questions on the assumptions? So let's recap a bit because so assumptions, model, aggregate demand. Number one, demand creates supply. Two, people save. Three, consumption dominates import effect. Four, Marshall Lerner condition. And here I can just be more explicit. Increasing Q leads to increase in current account. Here we're saying that changing C income is greater. Import change in y minus t. Yeah, and then people save. This one says that changing consumption with respect to domestic income is between 1 and 0. Right? So if you don't save, each additional dollar you get is just that, right? And demand creates its own supply. That just means that AD equals Y. The equilibrium Y must be equal to aggregate demand. So I'll show you this graphically. So let me review the mechanism. So The mechanism is the following, in which Q impacts demand through the CA, right, through the current account. The way it works is that if Q rises, that means domestic goods and services are cheaper relative to foreign goods, because foreign goods are getting more expensive or domestic goods getting cheaper. And so domestic goods are more competitive, right? So that's one way to think about it. And yeah, so as people from other countries or people within the economy shift their consumption towards domestic goods, output is going to increase. So Q will raise aggregate demand for home output. And this is only true, of course, when the volume effect dominates the Marshall line condition. The opposite is true for a decrease, the same idea. So an appreciation of Q makes domestic goods, services more expensive relative to foreign goods, services. Q shifts, decrease in Q shifts both domestic and foreign spending towards foreign goods. And therefore, a decrease in Q decreases aggregate demand. So I just wrote the inverse. All right. Comments, questions on how Q impacts D through the current account, also the assumptions for aggregate demand modeling for Keynes's demand creates supply model. All right, so let's talk about how Keynes explains how it works, right? So here I am plotting Y, so this is output or total planned expenditure. Again, or total income. Okay, so I'm gonna give you 3 ways, okay, to think about it. Output, income, planned expenditure. Same, all basically the same thing. That's Y. Let me just type it out. And then we have aggregate demand in the Y-axis. So the first assumption, right, which is the critical assumption, that demand creates supply. That's in this graph, a 45-degree line. Okay. So this is D equals to Y star. This is 45 degrees. So assuming there's no savings and everything that you demand is created, right? That's this 45-degree line here, right? So that's how this is how he presents his assumption here. However, remember this line though is not the aggregate demand curve for an economy, because here this is saying that assuming there's no savings, right? Everyone just spends what they earn, essentially. So given the assumption that we have savings, our actual aggregate demand curve looks something different. It's gonna have a steeper slope, sorry, a flatter slope. Something like this. This is our aggregate demand. One is T, I, G. Your question should be why? The reason why is because people save, right? People save, and so it won't be for a one-to-one relationship as you see here, right? Because this one says that every dollar I get translates to aggregate demand. But if that's not true, then it's going to be less than one-to-one, right? It should be a flatter curve. The steepness of this curve basically tells us how likely they're willing to spend their money, how quickly the money is spent once it's earned, right? So if there's a high savings rate, it's going to be a very flat curve. If there's a low savings rate, it could be like this, right? So it's important to know that I'm changing the slope from this point here. This point here tells us that even if the economy produces nothing, there will always be demand for something. Okay, right? Because here we have output equals 0. Output equals 0. Yet aggregate demand is positive. Okay, so that's baked in to the model. Okay, well, everything, I'm just making assumptions here, right? Demand creates its own supply. That's represented by this 45-degree line. So what this tells us is that the equilibrium output is somewhere on this line, right? That's what it's saying. Number two, there's savings. People save money. So there's less than one-to-one relationship between spending money and aggregate demand. There's savings. So the slope is flatter. But another way to say this is that when the output is 0, there's still excess demand. There's some demand, right? The steepness of the slope tells us how intense the savings rate is. So the flatter the curve is, the more likely higher propensity people to save. The steeper the curve, the more likely they'll spend money if they get new money. In other words, velocity of money, right? People are more likely to spend, and so there's more output, right? You can imagine, right? If I get steeper, output's higher, right? People spending money boosts the economy, okay? All right, so how do we achieve this equilibrium point, right? You should be asking. Well, the logic here is to think about points along the line in which we are not at this point here, right? So there's two scenarios to think about. This point here and this line here, right? Because this one tells us demand. Demand is higher than output, right? That's why it's D comma Y, okay? Because I can write D and Y in the same axis here. So here we have aggregate demand exceeding output here. Sorry, I got it switched. No, I got it flip around. So sorry. This line is aggregate demand. This is demand. And this is output. Okay, so output is greater than demand. In order for businesses to save money, so what's going on in this scenario? You have businesses' inventories growing. You have, therefore, things aren't leaving off the shelves fast enough. You have surpluses growing, and businesses can therefore save more money by reducing inventory. So they want to produce less. But when you produce less, you're also cutting labor, right? You're firing people, and you can save money that way. And so output slowly shrinks, right, towards this intersection. So here we have overproduction. Because if we are at this point here, right, we are making too much in response to our demand for goods and services. So over time, the economy will shrink until nothing wants to change anymore, right? Demand equals supply. Now, on the other side, we have here, this is the output, right? This is the output, and this is the demand. Here we have demand. So I'm gonna write D1 I1, D2 I2. So demand here exceeds output. The business's inventories are shrinking really, really fast, and they can make more money by producing more stuff. So what they'll do is they will hire more people. Those people will make more stuff. People will have more income. It's a feedback continuously over and over again. And so what's going on is we have output expanding over time until nobody wants to make any more than necessary, right? So equilibrium is achieved when aggregate demand equals aggregate supply, essentially. Whatever is in the right, y equals right, y star. So y here will represent supply, right? All right, comments, questions. So let me recap a bit. So here I'm trying to explain the mechanism in which an economy achieves equilibrium, in which no more goods or no more less goods are produced than necessary. We assume there's no excess or shortage. And to do that, we need to make an assumption about how supply is changed. In the Keynes model, supply is changed in response to changes in demand. And that requires this vertical line, 45-degree line that basically says that as long as there's D, there will be Y to meet it, right? That's what this 45-degree line means. As long as there's D, Y, there will be an output in response to that D. Now, our real aggregate demand line won't be exactly this 45-degree line because we assumed that households in our economy will save on average. There is some amount of savings. And so there will be a slope that's different from 1, right? Or less than 1 or greater than 0. 0 means no, all savings, right? Here we have some savings, but definitely greater than savings. Not 100% of your savings is going to go into, not 100% of your income is going to go into savings. So you get a positive sloping curve, but not exactly a slope that's equal to 1. Now, in order to determine what the equilibrium is, you think about points on this graph in which there is an overproduction or underproduction. And then you conclude that these points are not stable because businesses can make more money by either expanding output or curtailing output, reducing output. So on here, the right side of the intersection, we have overproduction because aggregate demand, which is this line, is smaller than output, right? Meaning that there's too much being produced and businesses can make more money by uh, reducing their inventories, making less, firing people. And as you fire people, there's less income, right, being made. And over time, this point here should move towards uh, this point here, right? So I guess here, right? Until just enough stuff is made, right, to meet demand. The same argument for the other side. If you have overproduction, sorry, underproduction, in which you have output being lower than demand, the logic is businesses can increase profits by making more stuff to meet the demand. But to make more stuff, they need to hire more people. Hiring more people means more income. That feeds back into more consumption, more production, etc. And production is going to expand until there's just enough stuff that equals demand. No more hiring, right? No more changes in labor supply or capital, whatever. We have an equilibrium. Y star equals D. All right, so this is just this is not all this stuff I explained to you. It's not necessary to make predictions on how output impacts exchange rate. But here I'm just giving you the inner workings, okay, the stuff behind the machine, right? How do the gears work? This is how the gears work. All right. Um, okay. So maybe let me talk about one more thing in which um, so let me spend some time talking about a shifting this curve here, okay? I'm trying to think if I should talk about this now because it's a bit more work. Um, let's just take a break because I think it's going to take some time to explain, and I don't want to have a break in our discussion. Yeah, so let's talk in 10 minutes. Um, I have this the attendance sheet here, so uh, there is a column that's supposed to be for last week, so please skip a column and start the attendance check mark on the next column, right? Because I'm going to check that column based on whether or not you submitted a midterm, okay? right. Let's get back. See. All right, so on this slide, um, I need to talk about the ultimate goal here. We need to come up with a new graph now as opposed to the graph that we've seen before. So in the graph that we looked at before in the short term, looked at the following, right? E versus R versus L. But we want to summarize this entire graph now with a single curve. Because we need to represent these variables along with this aggregate demand model on a single graph. And so we want to represent this entire market with a single line eventually. And so what we're going to do is try to formulate an equation that represents this entire graph such that we are plotting E versus Y. Okay, so that's today's agenda. Our final objective here. The reason why we focus on the relationship between E and Y is because Y is what the real economy is about, right? This is talking about economic growth. And as you suspect, you may have noticed that the relationship between E and Y seems very different here in the aggregate demand model versus than what we've seen before. So if we just do a very quick exercise of what's the relationship between exchange rates and output, we can just do a very quick, model shift here. So if we shifted the liquidity preference curve outward because Y is increasing, right? Then we have interest rates increasing from R to R. So I'll replot this later on, but I just want to mention this beforehand. You can see that the exchange rate actually gets stronger, which makes sense, right? Because if Y is getting stronger, there's more demand for the same amount of goods, or there's more income, right, than before, but interest rates have risen, and so exchange rates therefore the domestic currency must get stronger, right? More demand for the currency. So there's a negative relationship between E and Y. So if the Y increases, then E decreases. But based on our understanding of the aggregate demand model, which is just this equation here, equal to Y, increasing E, for example, will lead us to conclude that aggregate demand must increase because the current account increased, right? So increasing E must lead to more exports because of the Marshall-Lerner condition, which should lead us to more Y, right? So the relationship between E and Y is the reverse, in fact, right? Because here we have import-export responding to exchange rates being more attractive. Goods and services becoming more attractive, domestic goods and services becoming more attractive because of a weakening of the currency. But here we have the opposite. The relationship between output and E is the opposite because there's more demand for domestic goods, and as a result, the currency gets stronger as a result because of this wealth shock. So we want to make that distinction on a single graph between these two markets. All right, so the objective here is to show you this relationship between E and Y for the real side of the economy with respect to E, and then show you that that's fundamentally different than the relationship between E and Y in the financial markets. That's the ultimate goal here. And we're going to try to plot it on a single graph. And the equilibrium solution, therefore, is when everybody is happy, right? All markets clear. And I want to be able to show you that in this graph only, this simplified graph. All right, so let's do a thought experiment to fully understand the relationship between E and Y and the so-called DD schedule. So the DD schedule just refers to all equilibrium sets, all entire set of equilibria for E and Y that clears the real economy, i.e. demand equals supply, right? So we want to characterize the entire set of E and Y points in which aggregate demand equaling to supply, right? Such that we are in this intersection here. And to understand that relationship, what we will do is just to show you the relationship between E and Y by changing E and seeing what happens to Y in this framework. And I think it's very straightforward, actually. So let's walk through it. So if we have a short-term model, as usual, we assume that prices are sticky. So P and P star do not respond. And therefore, we don't impose relative PVP. We allow it to break. We don't have to impose it. So just set it aside. Okay. In which case, E is allowed to move. And if E moves, then we're going to have a change to Q. So Q not being constant must reflect, therefore, the change in E, and therefore there will be incentives to increase exports or decrease imports, etc. Right? So in the case in which we have an increase in E, the spot exchange rate, increasing E will increase Q, which is equal to EP star over P, remember? This means that the price level of foreign goods and services are more expensive than before, tilting everyone's to prefer consuming goods created by the domestic country. And so we should see the current account rise. And based on the aggregate demand function, right, it's going to be a function of the current account, which is a function of Q. And by the Marshall-Lerner condition, the current account increases, then aggregate demand increases, and therefore total supplied increases, output supplied. So we should see Y increasing, right? That's the chain of logic here. And it's fairly easy to see in this graph here, right? Because all we're doing is changing something in the aggregate demand function that's not on the axis, so the entire curve shifts. And when the entire curve shifts, you get a new equilibrium, right? That's going to be at a higher intersection than before. And let me show you that right now. So here we have the 45-degree line. Again, the 45-degree line represents demand creating supply, just saying that E equals Y star, right? And if we have a starting aggregate demand function, let me tell you what that function looks like. I mean, what changes. Q. So if we have, oh wait, so for any choice on this line, if I increase E, that's going to increase Y. And so if this side is greater than the left-hand side, then supply must respond, right? So what that means is that the entire curve must shift upward, right? Rather than draw those arrows, let me just draw this. So let's say we're here. What the steps in which the sequence of steps in which we approach here is the following. It's the same logic as I explained before. At this point, our demand, aggregate demand function has jumped to a higher level. So this is our demand, right? Yet this is our supply. So this is not a stable equilibrium because businesses can make more money by making more stuff, right? And as they make more stuff, they hire more people. There's more people having income, and we're therefore shifting towards this equilibrium at a higher output because businesses are expanding in response to a more favorable exchange rate, right? A weaker currency makes exports attractive. And so output expands until no more hiring is necessary, right? There's no more money to be made because everyone has created enough stuff to satisfy all demand. And we're done, right? So the effect of a depreciation of the currency has a positive effect on output, right? So this movement along this line has a name. This is called the Keynesian multiplier. And as you can imagine, the multiplier is stronger if an economy has a weaker propensity to save, right? Or a stronger propensity to spend. So that's the steepness of this curve. So if it's steeper, you can see that, right? The effect is much larger for a steeper curve. But the same, of course, the same intersection. All else equal, right? We're saying all else equal. All right, so does that make sense? So I guess review a little bit to make sure we really understand what's going on here. In this graph, we're showing the mechanism at play here in which an economy achieves an equilibrium output level in which nobody wants to do anything anymore, right? No more people hiring, inventories are at a stable level in which it's not growing or shrinking, it's at a stable level, and everyone's happy, right? Now, in order to have this economy work the way it does, we have to make two big assumptions. One is, as long as there's demand, there will always be supply, which is represented by this 45-degree line. The second big assumption is that there is some amount of savings in this economy. People want to save, or you can think of it as a risk aversion parameter or whatever. And that determines the steepness of this curve, right? Based on these two assumptions, equilibrium is achieved. If you think about scenarios in which we're producing too much or not producing enough, shortages and surpluses. When there's a surplus, businesses have incentives to save by cutting costs, by firing people. That reduces income. So the economy shrinks until things are stable, in which enough is produced to satisfy all demand, right? Supply equals demand. On the surplus side, I'm sorry, on the shortage side, same idea, but the reverse. If they can make more, they can expand production by selling more stuff, by hiring more people to make more stuff. People make more income, that drives consumption, etc. It multiplies over and over again until we reach a stable point in which supply equaling demand. So this has to be true under this framework that Keynes designed. Right. Whether it's realistic, that's subject to debate, but it's supposed to show you the mechanism of spending and saving and how that impacts output, right? And it links also the exchange rate and how that can boost aggregate demand through an output. So, okay. Now, what I showed you here is just a thought experiment in which we're trying to understand the relationship between E and Y in this, sorry, E and output in this real economy. Intuition, you already know what that is, right? A more favorable exchange rate means a weaker currency, which should drive exports. Yet, in the financial markets that we studied up to week 5 tells us that there's an opposite relationship. But here you can see it now, right? Favorable exchange rates, a weaker currency would boost exports because of the Marshall-Lerner condition, right? Volume effect dominates the value effect. Under this situation, increase in Q, which means a more favorable, your goods and services are relatively less expensive than foreign goods and services, will tilt countries towards buying your stuff, which will boost exports and aggregate demand as a result, right? And with higher demand, supply will meet demand. And as a result, output will increase. So there's a positive relationship here. Cool, right? That's all I've showed you. So now we know that increase in E will lead to increase in Y, right? That's the takeaway here. And we can now formally show this relationship on, an E versus Y graph, right? That's our end game here. So the DD schedule, again, means that we're talking about combinations of E and Y such that D equals Y, right? Y star. We want to find combinations of E and Y such that aggregate demand equals supply. And we know that there's a positive relationship between U and Y, and we can represent that positive relationship with an upward sloping curve, right? And what I will do in this class, I will label this curve as DD. And in addition to the DD, I will write the equilibrium condition that Y equals D as a function of disposable income, government savings, and the real exchange rate, EP star. Right. So I'm writing this to emphasize that every point on this graph satisfies this. Okay. Supply equaling demand for every combination of E and Y. Just like UIP curve, right? Just like the UIP curve is every combination of E and R such that carry trade is not profitable on average, right? Same thing here. Every point on this line represents an equilibrium in the real economy such that aggregate demand equals the supply that's being produced. It's upward sloping because increase in E boosts output. Because exports more competitive, right? Via prices, relative prices. Questions on DD schedule? So again, the schedule means it's not just I'm not thinking about a function per se, but rather a collection of points that satisfies a parity, right? That's what I'm talking about when I say a schedule. It's a literal, list of combination of points that satisfies Y equals T. So with that, to represent our real economy in the short term, we can now think about how to represent the financial markets also in this plot, right? And I kind of already gave you a hint of what that plot looks like. It should be something that gives us a negative relationship, right? This thing. So we want to represent this relationship on this graph. So let's be formal about it now. So if we recall from a few weeks ago, what makes up the financial markets is two equations, right? Two equations because that's literally what the short-term model looks like. It's E versus R in the FX market, right? And then we have liquidity preference versus R in the money market, right? Two markets, or the entire financial markets, right? FX and money. FX market is represented by the uncovered interest rate parity, and the money market is represented by liquidity demand and the supply of money set by the central bank. Equilibrium is achieved through interest rates, right? And to understand how E is related to Y, we can just do a Y shock, right? To see how interest rate respond and then how exchange rates respond. Let's go back to this exercise again. We have uncovered interest rate parity represented by this equation, right? And then we have liquidity preference. That's a function of interest rates output. To understand how E and Y is related, we will just change Y, right? Here, this model is not to determine, not to change E, right? E is the variable we want to see respond to a change in variable. So we're changing Y, right? So changing Y tells us that this curve here will shift away from the origin. And so the L curve will move rightward, right, to the right. All else equal, that means holding all other variables constant. Our interest rates must rise. The reason is because with more liquidity, with more wealth, more income, people will shift some of their money towards disposable or cash, right? And that means they're going to liquidate bonds, which will push down prices and push up interest rates. So interest rates shift this way. And exchange rates, therefore, carry traders respond to a higher domestic interest rate by borrowing foreign, lending out domestic, selling foreign for domestic currency, which pushes up the price, strengthening the domestic currency, so E moves downward, right? E not E prime. So the punchline here is that if I increase Y, I must observe an appreciation of the domestic currency. So if I were to represent this relationship on an E versus Y plot, that relationship must be a downward sloping curve, right? Because as I increase Y, as I go down this way, if I move away from the origin, my E must go down. So it must be a downward sloping curve. In this class, I will represent, so let me be precise what this curve represents. It represents the following. MS over P equals L R star plus E hat E over E minus 1 Y. Right. Do you see what I'm doing here? I have replaced the R here, right? This is the UIP. So what is this saying? This is saying two equations must be true or must be satisfied. Two equations have to be true, right? The UIP has to hold. That's R equals R star plus expected depreciation, right? And then we have the money market clearing, in which real money supply equaling real money demand. So just like the DD schedule, this so-called AA schedule is called AA because we're talking about assets, financial assets. Every point along this schedule is a combination of E and Y such that the entire financial markets are at equilibrium or market clearing everywhere in the financial markets. All right, so every combination of E and Y will clear this equation on this downward sloping curve, which is why it's called a schedule, because we're talking about combinations of E and Y that makes UIP hold and clears the money market. So maybe I will write it like this. So I wrote it this way because we focus on the ratio of E hat E over E, but if you want to be more intuitive, I guess, you can write as a return, it's fine. And this is equal to R. Right? So I want to emphasize here, this is all just the short term. Like we're not talking about flexible prices at all. Prices are assumed to be sticky. PPP is allowed to be broken. It's not, doesn't have to be imposed. You can just let it. It doesn't matter whether it holds or not. And we're just trying to make predictions about how changes in E, right, impacts Y, right? That's the goal here. But in order to find a stable prediction, a prediction of a stable point, we have to be able to clear all markets. And there's three markets to think about. FX market has to clear through UIP. Money market has to clear with real money supply equaling the real money demand. And then now we have aggregate demand equaling to total supply, right? So three things have to be true to find a stable equilibrium that is predicted based on variable changes. So as you can imagine, with a downward sloping AA schedule and an upward sloping DD schedule, market clearing across the entire world or all markets will be found at the intersection between these two lines, right? Because it's a stable point, E and Y, that will appear in both this set defined by the AA schedule, as well as the set defined by the DD schedule, right? So what I mean is the following, right? So we have downward sloping AA schedule, which is defined based on here. R star plus E minus 1, Y. And also an upward sloping curve, which is called the DD schedule. This is represented by Y equals T by G star. This point here, right? This is a combination of E and Y such that this is happy, this is true, and this is true, right? This is market clearing across all markets. This is output. And this is the exchange rate. Make sense? So let me make this clear. E not, Y not. satisfies both this equation here and this. All right, so to emphasize to emphasize the mechanism at play here, so how we actually achieve this stable point here, let's think about a shock, right? That's how we usually do things in economics to figure out if this is a really stable equilibrium. We perturb the model, we say there's a shock, and then we think about the mechanisms in which the equilibrium is restored again. So let's suppose that there is a shock. Let's suppose there is a temporary shock to a decrease to y such that we are at this point here, okay? So maybe there was an exaggeration. The financial markets got it wrong, right? There is a decline in output in addition to a drop, in addition to an increase in exchange rate, which is natural, but the exchange rate increased too much. So let's say it's E1 for our sake here. So how do we return back to a stable equilibrium, all else equal? So let's say nothing happens to D, but Y just suddenly dropped for some reason to Y prime, in addition to the exchange rate being elevated at this level, such that this point is not on the A schedule or the DD schedule. Right? So my question, so nothing else has changed. DD schedule remains the same. A schedule remains the same. How do we achieve equilibrium again here? That's the question I posed to you. Now, the way that things worked, the way things work is financial markets typically corrects things first, right? If prices are wrong, then finance arbitrageurs or carry traders will come in and restore equilibrium. So in this point here, because we're not on the AA schedule, E is too large, right? So recall the UIP equation. If E is too large, that means it's too large, such that we're no longer in parity. That means that we're like this, right? Like this. What needs to happen is that E needs to change, right? But how? It changes because carry traders will be able to make positive expected returns from carry trade. What they will do is borrow R star, invest in R. That means converting foreign currency for domestic currency, which will push E down such that parity is restored. So the first thing that happens is this point drops to the AA line. So I hope you see that, right? This is supposed to be instantaneous because carry traders are just always looking for maximizing expected returns. And for any given output, as long as E is too high or too low such that UIP is broken or violated, they will just come in and do carry trade and push E in a direction that closes the gap, right? This gap. And what you see visually, what I'm saying is that this point will drop precisely onto the AA schedule. Again, because every point on the AA schedule is market clearing in the financial markets, right? Everybody's happy in the financial markets as long as this point is on the AA schedule. All right, so now what you should be thinking now, well, this point is not on the DD schedule. So something has to change such that we are moving towards this, right? That's kind of what you should be thinking. So we can go ahead and look at the equations here to get an idea what's going on. So given this output level, right? We're still at Y prime here. We have an E, so let's say this is E double prime, that's higher than E naught, right? Remember, on this curve, right, the combination of this E with this Y will satisfy this, correct? This imagine this, I'm gonna write E triple prime, okay? E triple prime and Y prime will satisfy this equation, but we have an E double prime that's way above, right? It's way above the equilibrium point. So what that means is that with E that's too high, aggregate demand will exceed the supply. So what has to happen? Demand creates on supply. What has to happen? Output has to increase, right? Output has to increase, right? Demand creates its own supply. Y increases in response to this now elevated Q, right? Real exchange rate. So with E being higher than E triple prime, we have exports being more attractive, right, than foreign exports. And so there's going to be more demand for our goods. So D must be higher. E is higher. Keynesian model tells us that demand creates supply. And so eventually there will be stuff made to satisfy that demand. So we are now moving along this line, right? Output is increasing. But what you should be noticing is that, yes, output is increasing, but E is decreasing. Yes. In fact, as long as E is above the output, right? As long as the E is above this E naught, output will continue to increase. So there's a feedback effect, right? Output increases, great. Output increases, but it decreases E according to this model, right? Because we're moving along the A schedule. Does that make sense? So let me walk you through the steps again. We are at this point because carry traders come in, they push down the price such that market clears in the financial markets. But this exchange rate level is still far above the level in which aggregate demand equaling to aggregate supply, right? That's this point here. This is not equilibrium because given this E, there's going to be more exports, right? Because we know that an elevated E increases aggregate demand and demand creates its own supply. And so supply will increase. But as you increase Y, here, see it? So increase Y increases, we will be at out of equilibrium. To restore parity, something has to happen to E to make it equal again. In other words, L has to decrease somehow, right? L can decrease if this R, right? This is R, increases. And R, it can only increase if E decreases, right? That's why we're moving along this line, right? Okay, E decreases, feeds back into here again. But we realize that E level is still far above the equilibrium E, right? It's still too high. So output still continues to push upward. Do you see the feedback now? So the E The increase in E will increase output, but the increase in output will pare down the E, the change in E, the depreciation in the home currency. But that paring down the home currency is not enough to stop output from increasing. Right? It's not a stable point yet, according to the Keynesian cross. So output continues to increase, exchange rate continues to decrease until we reach a stable point in which aggregate demand equaling to supply, right? That's on the DD schedule. Everyone's happy in the real economy, but we've been just moving along the AE schedule the whole time. So the financial markets have always been happy. And so in the end, market clears only if E and Y stops moving, right? That's basically the mechanism at play here. All right, I think I may have lost some people. Okay. So let me walk slowly through the steps again. Maybe a new plot just in case, because I feel like this is important, right? Because this reveals the inner workings of how demand is achieves its equilibrium in aggregate demand equaling supply. The real economy clears, how the real economy clears, as well as how the financial markets and money market clears as well, right? It's everything clearing together. But because of the way we make everything interdependent, there is a feedback effect that kind of obscures how we achieve a stable point, right? How we achieve a global equilibrium. So we started out with a single objective here, right? How do we represent the real economy and the financial markets in the same graph? We focus on two variables, the exchange rate, because that's what this class is all about. How these exchange rates influence output, how it's related to interest rates, etc. This is the final augmentation to the model, okay? So anything after today is just additional bells and whistles. Once we have the real economy built into this model, we're done, okay? With E, we want to relate with output, right? That's our goal today. Aggregate demand is represented by an upward sloping curve because intuitively we're talking about export competition here, right? As E increases, it means that domestic goods become more competitive and therefore more people want to buy home domestically produced goods. That's going to boost sales, right? Production. People make more money, people buy more stuff, feeds back until total demand equaling to total amount of stuff supplied, right? So that's what the DD schedule represents. This is represented by this equation here, y minus t, I, g, and p star p, which is q, right? That's q. The ingredients to make this possible comes from two big assumptions. One is the fact that as long as there's demand, there will be supply, right? And the second assumption is we have to assume that there's some degree of savings. People won't spend everything they have or they make. And also, probably more importantly, nobody will save all of their money and don't do anything with it, right? So it's between the likelihood of spending, right, is somewhere between 0 and 1 in response to a increase in domestic disposable income. All right, so that's the aggregate demand equation that was introduced to you today. The old stuff is represented by what's called a schedule. It's a downward sloping curve. And all I'm doing is combining two equations that represents market clearing across money market and FX markets, right? The UIP plus the money market equilibrium condition. So here we have just everything put together. R star plus E hat E hat E minus E over E, comma, and then Y, right? All I'm doing is just replacing the R in the L function with, the other side of the equation, other side of UIP. So to reiterate what these schedules mean, each point on these lines is a combination of E and Y that achieves equilibrium in their respective markets. So E and Y on the DD schedule will satisfy this equilibrium condition, aggregate demand equaling to supply. E and Y on the A schedule means UIP is satisfied as well as money supply equaling to money demand. And identifying the E and Y that satisfies everything is precisely this intersection point. I'll write E naught and E, why not E naught just as a starting point, because the more important understanding of the mechanism involves us to do a perturbation, right? To introduce a shock and see what happens and to think about the mechanisms at play that allows us to achieve equilibrium again. So all else equal, suppose there is a income shock that's just arbitrary and nothing else changes. So suppose output suddenly drops to this point here. Okay, let's call it Y prime. And also let's suppose that the markets were somewhat irrational, right? In which we have an elevated exchange rate here. And let's call that E prime. Now, the first thing that must happen when something doesn't look right is the financial markets will try to correct it. So something here doesn't look right because this point is not on the AA schedule or the DD schedule. The financial markets respond first. When carry traders see an exchange rate that's too high. So recall the UIP equation. When they see an exchange rate that's too high, that means that it's profitable on average to conduct carry trade in which you borrow foreign and lend domestic. Too high, so these two, right? To exploit this, they will sell foreign currency and buy domestic, which means E will go the opposite direction. In other words, from this point will drop right onto the AA schedule. This point here. I will label this E double prime. So far, so good. So let me label this as step one, okay? Step one. Step one, financial markets, correct mispricing, carry traders, exploit interest rate differential. Right, that's step one. All right. We notice now that for this given output, so let's suppose this Y is Y prime, okay? For this given Y prime, the E level that allows us to clear the real economy is this point here, right? Because it's on the DD schedule. This is unacceptable for the financial markets, right? It will screw with the financial markets. So the E level is far higher than they're required to clear the real economy. So this gap here, right? This means that E is higher than before. So you have export competition, right? Export competition is better for domestic countries because E is elevated for this output, right? E is higher, so foreign goods and services more expensive. more people will demand domestic goods now, which means that aggregate demand increases greater than what's supplied. Keynesian model of aggregate demand tells us supply must meet demand, so over time, Y has to increase for this given E. Correct? So what this means on in this figure, let me delete this here, is that now we're moving along this line because output has increased. Increase in this output feeds back into this model here, this money market clearing / financial markets clearing here. Increasing Y forces us to decrease E. Right, I hope you see that, because if Y increases, L increases. Out of equilibrium, to undo it, we must decrease L, which requires to increase R, which means that E has to decrease in order for R to increase. So E is also moving down, right? However, this lower E feeding back into here is still higher, right? Still higher, right? The gap between this point here and this point here is still higher than what's necessary to clear the real economy, right? So output still keeps pushing up, continues to increase. So still elevated E, which means aggregate demand increases, which means output increases, which feeds back into here again. Increasing output pushes E downward over and over and over and over again until we move from this point here all the way to this point. So let me write that step down. Step 2. Exchange rate. Exchange rate E is higher than equilibrium E on ED schedule. Output increases. Right, that's step 2. More favorable exchange rate makes domestic goods and services more attractive. Higher Q leads to higher current account, leads to higher aggregate demand. Demand meets supply, supply increases. Step 3. Step 3, increase in Y feeds back into financial markets, which pushes interest rates up and exchange rates. Yeah. I think you know I can explain the mechanism here, but it's obvious, right? Higher, more income, more wealth means more people liquidating their illiquid assets in favor for cash holdings. That pushes bond prices down, interest rate up. Exchange rates therefore get stronger, right? And then step 4, 4, 5, 6, feedback until E and Y are in both AA and states. Make sense? So that's it. That's the full short-term model that incorporates market clearing across financial markets, and real economy. And from this, we can start to begin analyzing the impacts of government spending, tariffs, taxes, all those things, right? On your midterm exam, I made you analyze the price effects, right, of tariffs. I made you analyze the income effects of tariffs, but we've forgotten one other dimension, which is tax collection from tariffs, which could also have an impact. So with this augmented model, we can now analyze that other dimension of tariffs, which is relevant to whatever's happening right now with counter tariffs with China, etc. So this is very relevant stuff. All right. I think I will stop our discussion here, and then next week I will talk about changes in government spending and taxes, etc., and how that impacts exchange rates and output levels. So let me just spend the last 5-10 minutes just reviewing what we did today. Right? All right, so I think the most complicated part of today's class was understanding our model to represent the real economy, which is requires us to make some very strong assumptions on how supply is created, or supply of goods and services are created, and what demand is a function. We take stuff from the Keynesian model of understanding the macroeconomy, in which goods and services produced is taken for granted. We assume that as long as there is demand, there's always going to be entrepreneurs and businesses willing to meet those demands eventually. Of course, you can think of many examples in which that's not true, but for our purposes, that's good enough. And when you read the news in the Wall Street Journal or Financial Times, this is what they're thinking about. Okay, at least for those finance writers, now you know what they're thinking. Okay, two big assumptions that are necessary for making this macro aggregate demand model work is that, again, demand creates supply, and also savings. There's some degree of savings in the economy. So here I'm just saying that consumption in response to a change in domestic disposable income is somewhere between 1 and 0. So not everything goes towards consumption. Some of it is saved. So if that's true, then in our Keynesian cross model, our aggregate demand function will be not a perfect 45-degree line, right? It will be something that's between a slope of 0 and 1, right? So the steepness of the slope tells us how likely a country is willing to spend money when given some money, right? I imagine China's aggregate demand function is quite flat versus US's economy, but that's something we can analyze later on. But now you can imagine how to think about countries now, right? Through their propensity to save/spend. The aggregate demand function looks like the following. It's a function of consumption, investment, government spending, and the current account. I'm just pulling out the key parameters that move these individual pieces of aggregate demand, right? Consumption, investments. So consumption is a function of disposable income. Investments assumed to be taken exogenous, meaning that it's outside the model that doesn't depend on anything else. G, the same thing, and then Q is our link between the financial markets and the real economy through import-export competition, right? As Q rises, that means for domestic goods and services are relatively cheaper, and so we should expect that with a higher Q, more goods will be produced domestically to be sold abroad, right? This, of course, relies on the assumption that the Marshall-Litter condition is satisfied, meaning that this equation here is greater than 0. That's all I'm saying. This is important because in reality, we don't know to what extent Q passes through the current account. So this is a econometric question that you have to answer country by country, right? So we don't know exactly what this sensitivity is, but if you want to come up with a number, you need to actually dig up long histories of data and conduct some sort of econometric model to estimate this relationship. So that's beyond the course. All right, the key mechanisms in which this aggregate demand model works is the following. As long as we are having a surplus or having a shortage, businesses and companies have every incentive to shrink or expand employment, right? Which will move us towards the equilibrium point in which there's no more hiring than necessary, and we're producing just enough to meet demand, right? So for example, if demand is smaller than what's being produced, that inventories are increasing, right? This is a cost that businesses can avoid by slowing down production or firing people, right? This will cut back income, right? And therefore output would decrease over time. Conversely, when we have the opposite direction, when demand exceeds supply, then we have inventories falling and businesses can make more money by making more stuff, hiring more people, more income, and then feedback, et cetera, until we reach an equilibrium point and until we have just enough stuff to meet the demand. Right? All right, so with that model, we derived a relationship between E and Y, right? We determined that E and Y for the DB schedule is positive, right? E versus Y, it's a positive relationship. And for the A schedule, we already know this, right, from past few weeks, that there's a negative relationship between E and Y. All we did together was plot these two schedules together on the same graph, right? E versus Y, and realize that market clearing everywhere involves its intersection, right? And I gave you two equations to represent these market clearing conditions. This new one in which I combine UIP with the money market, and also this one to represent the real economy in which total output equals total aggregate demand. Okay. And then this is exactly what we went through step by step together twice just to make sure there were no confusion. So yeah, so that's it for today. So I hope I did an okay job explaining this last piece of this exchange rate model. So if you have further questions, you can come up and ask me now. Otherwise, next week we will talk about policy shocks from the government side, so fiscal policy. Last few weeks was all about monetary stuff. Next week and the week after that, it's going to be all fiscal stuff. All right. Okay, so see you guys next week, and I will have your exams by next week, and then I will spend the first half of the class going over the solutions, of course. Okay. All right.